Right. So fund based again in the chapter 2 we are going to discuss detailedly. Okay. So whatever the here introduction is there, I am going to talk financial finance, lease financing. Lease financing, commercial contract between the owner and equipment, owner of the equipment and prospective user of the agreement. Generally, when we are observed with the lease agreement is there, that is only. Hire purchase. Hire purchase take the equipment of lease and lease rental is shown as tax deductible. The expenses, but lease cannot be claimed the depreciation, but not show the lead of the lease balances. So hire purchase is an agreement and a agreement which is goods let out by the hire, under which hirer has option to purchase of the according to with the terms and agreements. Venture capital. Venture capital is a initiated entrepreneurs to invest in very risky projects. Insurance services, factoring and forfeiting. Factoring is a process of converting credit bills into the cash. So some middle management will be involved. Forfeiting is the conversion of foreign credit bills into the cash. This is domestic related. This is the non-domestic related. House financing. Generally, housing industry priority give the loans various plans to the emphasizing of need of promoting the housing finance. Mutual funds. So these all are we are going to discuss in the second unit. Okay, I will explain. Yeah, yeah, this one. See, fund-based financial services detailedly in the chapter 2 is there. So already fund-based means what? So financial institution, they are going to invest and they are going to involve with the exchange of funds. Financial fee-based means what? For providing a financial services, certain fee they are going to be collect. So leasing financing, just now I explained, this is the agreement between the two parties, lessor and lessee, to use of certain asset, and end of the period, the user is have a chance to buying it. So housing purchase is there, housing purchase is there, consumer credit is there, factoring is there, provider is there, housing finance is there, bill discounting is there. So equipment leasing. Equipment leasing means what? A leasing transaction commercially arranged whereby the equipment owner or manufacturer convey to equipment user right to use of the equipment written for the lease rental. Generally, for example, there is a one property. Owner is there. User is there. Owner will give right to use of these assets. Okay, to the user. User can use and pay the some amount to the owner. So end of the certain period, user have a chance to purchasing of this property from the owner. They can transfer the asset. So this is called as a leasing. Generally, this lease we have two types. So two types of lease we have. That is operating lease and financing lease. Okay. First, operating lease means what? See, when owner is there and user is there, when the property is there, owner can send only transfer of right to use, not enter the process. That related maintenance and risk related all the cost is beared by the owner only. Only owner will give the option to users to using of that asset. User can use the asset, then he can pay the money to the owner. So that is only. Next, finance lease. So here, risk and related repairs, rewards also, ownership also going to be transferred to the users after certain particular period. Next one is hire purchase. According to Hire Purchase Act, it is an agreement under the which goods lent out by their hirer under their hirer the option of purchasing of them. Hire purchasing is type of installment credit. Under this sell the goods under this method, selling goods are let on hire by the finance company creditors. So hirer purchase customer. Simply bikes, vehicles we are going to purchase. For example, Maruti car is there. Maruti car is there. Customer want to purchase this car. When he doesn't have sufficient money to pay, he's going to take the loan from the banker. So banker, what is going to do? Banker will pay to the money to the company, and banker can collect the money from the customers. So when the customer has failed to pay the installments to the bank, automatically this banker will take the property from the company. He become a seller. He can take back when he fails the company. Okay. Okay. Sorry. Right. So this is the hire purchase system. So these all are fund based only going to be work out. Consumer credit. They are going to give the credit loans to the customers. Bills discounting. So bills discounting also there is a different process. Generally, these non-banking financial corporations they are going to do that. So instead of payment of bills for behalf of the customers, they are going to pay. Again, they are going to collect from the customers. So there is a different types of bills are there, like demand bills. Demand bills means paid immediately at right. Next one is the assents bill. The bill allows the drawer to have the period credit of terms. Next, documentary bill. These are the document bills are accompanied by the documents confirmed by them. Clean bill. The bills of exchange drafts drawn by the payable overseas which cannot be accompanied. So they just go through that. Venture capital. Venture capital means what? Venture capital is a risky money which is used to invest in the risky enterprises, either equity or either debt capital. Simply, on new project, when there is a risk involved highest, they are going to invest in the amount in this project, in this type of projects. So simply, they can invest first time on innovative project, new creative project. So this only. So next one is the housing finance. To develop the housing finance corporation companies, non-banking financiers, they are going to provide the loans. Factoring and forfeiting. So factoring is different, forfeiting is different. Factoring is a services financial nature involving the conversion of credit bills into the cash. So the accounts of receivables, bills receivables, other credit resulting from the credit sales appear in the books of accounts as books of credits. Here, risk of the credit terms witness to the debtors, the number of incidentals. So these are the factoring. Simply, I can say that. So there are three parties involved: customer, factoring agency, and seller. Customer is a purchaser. When seller want to sell one X product to the customer, he is going to sell the product to the customer. So customer can pay the money to the seller. So seller is going to receive that the bills exchange of bills receivables. So these bills receivable, they are going to give the financial institutions. They can withdraw from this here. Again, these financial institutions, they are going to collect from the customer. So this is that. So factoring is nothing but the collection of bills receivable from the customer behalf of the seller. So seller can get the advance from the financial institution. So this is the domestic related only. Factoring means what? The financial against the receivables like factoring. The technique is forfeiting mostly employed help to the exported to the financing of exported and imported goods. Mutual funds. Mutual funds means what? It is the small savings which are collected by the small investors. That pool of money is going to invested in the somewhere. So that is mutual funds. Insurance companies we know already. Okay. Hmm. Right. So these are the fund based only. Next one is fee based. Yeah. See, previous cases all are they involved money to provide that financial services. These fee based financial services, they won't investment much money. They won't investment much money. Without money, whatever the experience they have, then they are going to use the experience, and they provide the services, services to the, they provide the services to the their clients. Is it clear? So that fee based services are like issue of management, portfolio management, corporate counseling, loan syndication, mergers and acquisition, capital restructuring, merchant banking, credit rating, stock brokering, depository services, okay, P2P lending, crowdfunding. So these all are fee based financial services only. Chalo, let us discuss one by one. First of all, what is the meaning of fee based financial services? Fee based financial services also called as a advisory and ancillary financial services and non-fund credit facilities. So generally, these are they are going to provide the services to their clients. Types of fee-based issue of management services. See, issue of management services deals with the any company when they want to raise the capital, they compulsory issue the shares that related all the services done by the some companies. So like public offer investment, private placement, rights issue. So these all are the modes of issuing of share capital. These are all services done by the some financial institution. Generally nowadays nowadays all the banks also they are doing these services. So next one is the portfolio management. See, you are an investor, you want to invest in the stock market, but you are not able to invest where you want to invest. So in these situations, so they are going to provide the services, advisory services to their investors. So for that they are going to be charged. So they like, this is the example, advising the clients buying and selling of the securities and indicating the stock picking, fulfilling the complete requirement, pooling the returns. These are like this. Corporate counseling. Corporate counseling includes that activities undertaking to ensure the efficient running of corporate business. Okay, like this. So next one is after corporate finance, corporate counseling, loan syndications. Some of the agencies they are going to work for the getting of loans. The whatever the requirement process is there, that all are done by these institutions. So they are only mergers and acquisition services. See, when you want to acquire any company or when you want to merge with any other company, to know the other company financial position, it is very difficult. Some of the middle persons, they are going to analyze their company details, and they are providing the services, whether you want to merge or acquire the other companies, that related only. So these types of mergers is different. So merger, horizontal merger, vertical merger, conglomerate merger. Horizontal merger talks about the two firms, that same industry, they're going to combine and they start the new company. Vertical. So different stages of the production distribution. To the vertical merger talks about the expanding of business. One here two same industry, but here other industry. So one can adapt the other one. Conglomerate involve the firms engaging the unrelated lines. So X company talking dealing with the textiles, Y company talking with the computer software, even though they are ready to take over that. So like that. So these are the types of mergers. Capital restructuring services. Formation of capital, restructuring of capital services are very important. So they are going to provide this only. And increase or decrease leverage. These all are the just part of that services of financial services only. Merchant banking services. See, merchant banking services talks about the that that merchant banks can provide the financial services to the those who require financial knowledge, and those who are involving in the whether they want to take any loan or they want to buy anything, they want to sell anything. So behalf of the companies, these merchant bankers can do the operations. For doing of this, they are going to charge certain amount. So functions of merchant bankers generally, they are going to provide the advising, and they are going to help to getting of licensing and obtaining of consent of central and state government, and proportion of economic, technical, financial feasibilities, initial project preparation, pre-investment surveys, market studies, and help the raising of rupees and resources, underwriting services, subscription services. So these are the examples. Credit rating services, credit rating agencies. Generally, credit rating agencies are different. So they are going to analyze the company's performance. Based on the company performance, they are going to give the rating. That rating will help to the investor to take whether they want to invest in that particular company or not. If they discontinue their investment, based on this rating services only they are going to take. Next one is the stock brokering services. And stock brokering services, buying and exchanging of stocks, they are going to provide the clients whether they want to buy or sell. Depository system. Depository system just nothing but the maintaining of equities and debt to mutual funds, insurance policies. Instead of traditional method, they are going to maintain the digitally. And P2P lending. So P2P lending talks about the pure form debt lending. So crowdfunding used by the raising of loans. So crowdfunding. It is a modern way of raising of finance using by the various technology based on the platforms and sites. It is practice of raising the funds from the maybe different brokers, crowd forms, small amounts, small portions of capitals. This is different. So this is the story about the fee-based financial services. In first unit, you have to remember only three important questions. That is, first one is features of financial services, importance of financial services, and types of financial services like fund-based and fee-based financial services. So these are the very, very important. Just if you concentrate on this, that chapter is going to be end. In the next class, next chapter, I'm going to talk Black 2. Please concentrate on it.